Welcome to the deep dive. Today we are doing a really focused exploration into some real estate dynamics that frankly can be pretty confusing if you're just reading the headlines.
Right.
We're setting our sights on North Texas, and we're going to be decoding the November 2025 reports from the North Texas Real Estate Information Systems, or NTRES. People usually say NETRES.
That's right. And if you only follow the national news or even just the big headlines coming out of Dallas, you get a very simple story.
A simple and pretty negative story.
Yeah, that high interest rates have basically put a freeze on the market. We've all heard about the golden handcuff effect, where, millions of homeowners are just sitting on these amazing sub 4% mortgage rates, and they just have no incentive to sell, and that just slows everything down.
Right. That narrative suggests pain, a big slowdown, and just uniform price drops across the entire Metroplex.
Exactly.
But if you're an informed buyer or seller, trusting that big, sweeping story is, well, it's a recipe for making some really bad decisions.
It really is.
So our goal today is to use the hardest, most recent data we have, this is current as of December 8, 2025, to uncover what is really a profound statistical paradox. We want to show you exactly where that regional pain ends and where this hyper-localized, unique demand begins to create a completely different set of market physics.
And that's the plan. We'll start by establishing the broad NTRES data as our baseline. We need to confirm just how, soft and sluggish the wider DFW region has become.
Okay.
And then we're going to pivot hard to Wise County. It's about an hour northwest of Dallas. And the data there shows this exceptional resilience. It's bucking every single major trend we see in the core Metroplex.
The difference is really that stark.
Oh, it's night and day. It really proves that a local economic rhythm can completely override the big macro market conditions.
Okay, let's unpack this. I think you're right. We need to feel that regional pain first so we can really appreciate the Wise County anomaly when we get to it.
Let's do it.
So, starting with the baseline for the entire NTRES region, and we should remind everyone, this covers a massive area around Dallas and Fort Worth.
Huge.
If we look at the raw numbers, the evidence of a market slowdown, especially in just how many homes are actually being sold, it's not just clear, it's pretty alarming.
It is. It's the biggest sign of friction in the whole system right now. Let's call it the slowdown in transaction volume.
Okay.
When we compare closed sales year over year, so November 2025 against November 2024, the whole region saw a really significant double-digit drop.
How much?
Down 11.1%. We went from about 8,600 closed sales down to just over 7,600.
So nearly 1,000 fewer homes sold in 1 month compared to the year before.
Exactly. That's a huge drop in activity.
An 11.1% drop. That doesn't just feel like a cooling market. It sounds like a sudden, pretty acute contraction. How sure are we this isn't just normal seasonality? I mean, November is always a bit slower.
That's a crucial question. And yes, a degree of seasonality is always expected, but the magnitude of this drop, that's what points directly to some serious market friction.
Okay.
This 11.1% decline is a massive signal that golden handcuff effect is biting deep. The number of sellers willing to give up their low rate just isn't enough to meet the buyer demand that's left.
And that demand is already lower because of the higher rates?
Of course, the buyers who are still in the market are looking at mortgage payments that are, 40 to 60% higher than they would have been just 3 years ago.
Wow.
So when that happens, transactions just seize up.
So you have buyers who are balking at the payment shock, and you have sellers who are clinging to their low rate. That 11.1% drop is basically the market's mathematical answer to that stalemate.
That's the perfect way to put it. And it's not an isolated event. It's being preceded by a shrinking pipeline of future sales.
You mean pending sales?
Exactly. Pending sales. So these are offers that have been accepted but haven't closed yet. They also dropped year over year.
How much did they fall?
They were down 4.1%. Went from around 7,900 down to 7,600. So this narrowing pipeline, it just confirms the slowdown is systemic. Fewer people are even getting into the contract phase.
Which means the transaction numbers for, say, January and February are probably going to stay pretty depressed.
Very likely, yes.
But here's what's so fascinating, and I think really critical for people to understand. While November looks grim, the year-to-date figures for the region are actually slightly up.
Right. It's a small difference, but it's important.
Closed sales year-to-date are up 0.2%, and pending sales year-to-date are up 1.0%. What does that little difference tell us about the market's trajectory?
That YTD detail is maybe the most important piece in context in this whole section. It suggests that the market had a pretty solid first 3 quarters of 2025.
So a strong spring and summer.
Yeah, probably a strong spring, early summer. Maybe it benefited from some pent-up demand or, some temporary dips in rates. But the fact that the volume is flat to slightly positive for the whole year, yet November saw that massive 11.1% drop.
It means the slowdown has been really dramatic and really concentrated in just the last few months.
Exactly. It's acute. It's like the higher rate environment suddenly hit this critical tipping point in the Metroplex, and it shifted buyer sentiment almost overnight.
Okay, so if fewer transactions are happening, the logical next step should be an adjustment in prices, or at least homes sitting on the market longer.
All right.
Are we seeing sellers adjust their expectations to meet that sharp buyer resistance?
Regionally, the answer is a very clear yes. The median sales price, or MSP, for the entire North Texas region dipped 5.4% year over year.
And it's settled where?
At $352,900. For anyone who's been tracking this market softness, this is the definitive confirmation. Prices are visibly adjusting downward across the region.
That price point, $352,900 for the regional median, is fascinating because it puts the North Texas market in such stark contrast with the national picture.
It really does.
If you look at the National Association of Realtors reports, the national median existing home price actually increased.
Right, it went up 2.1% year over year to $415,200.
That's a $60,000 difference in the median price, and they're moving in opposite directions.
Yeah. And this divergence is the perfect illustration of why national headlines are often so useless at the local level.
Right.
Nationally, prices are still climbing. It's been an incredible 28 straight months of annual gains, even with lower sales volume. The U.S. market, on average, seems to have kind of accepted this new normal for pricing.
Not here.
Not here. Here in North Texas, across the Entresses area, sellers are being forced to visibly correct their prices. This isn't just a pause. This suggests that the price growth we saw in 2021 and 2022 was just so aggressive here that a corrective phase is now mandatory to get back to some kind of equilibrium.
It's like buyers here are finally saying, we will not pay 2022 prices with 2025 interest rates.
That's exactly what they're saying. And if prices are softening, then the velocity of sales, the speed, must be slowing down dramatically too.
That 11% drop in volume certainly suggests that buyers are taking their time, they're negotiating harder.
That's precisely the psychological shift the data is confirming. Take a look at days on market, or DOM. This might be the most crucial metric for understanding the psychology of the regional market.
And what's it doing?
The average time a home spends on the market until it sells jumped significantly. It's up 16.7% year over year.
From what to what?
We moved from 60 days on market in November 2024 to a full 70 days on market this November.
10 extra days. Now, that might not sound like a lot to some people, but that shift from 2 months to well over 2 months, that fundamentally changes the emotional landscape for both buyers and sellers.
It changes everything from a strategy perspective.
How so?
Well, in a 60-day market, sellers still held a bit of a psychological edge. They could afford to wait 2 months and then maybe make a small price drop.
Sure.
But in a 70-day market, the buyer has distinct leverage. That extra 10 days means more time for the buyer to compare listings, more time for sellers to feel the pressure of their carrying costs, and more time for negotiations to get really deliberate.
It absolutely signals the end of that rapid, frantic bidding war environment we were talking about.
Absolutely.
And is the 70-day average just a 1-month thing, or is it a longer trend?
No, it's not an anomaly. If we look at the year-to-date DOM, that figure is also up. It's risen 18.5%. It moved from 54 days to 64 days on average for the year.
So even though the November jump is pretty sharp, the whole year has been a steady march towards slower sales.
It proves that listings that aren't perfectly priced and perfectly presented are just sitting.
And we can actually quantify that loss of seller power directly, can't we? The percent of original list price received, that metric dropped 1.3%.
It did. It fell from 94.3% down to 93.1%.
Let's translate that 1.2% loss for people listening. What does that mean in real dollars?
Well, when you're dealing with a median sales price of around $350,000, a 1.2% loss is over $4,200 in lost pricing power.
And that shows up as what? Price reductions?
Sometimes direct price reductions, but what's more common now are seller-paid concessions for the buyer.
Like paying for closing costs or buying down their interest rate.
Exactly. It's definitive evidence that sellers are increasingly having to sweeten the deal just to get transactions across the finish line. in this new, slower regional market.
Okay, so we've established fewer sales, lower regional prices, and slower closing times. Let's talk about inventory. Is this slowdown finally allowing supply to catch up with demand across the broader Metroplex?
Supply is responding, but I'd say only modestly. It really reflects that golden handcuff constraint we talked about.
Okay.
The total inventory of homes for sale across the whole Tri-County region grew by 3.5% year over year. It's at about 47,000 units.
And that pushes the month supply of inventory up to what?
It edges it up by a small 2.1% to 4.8 months.
4.8 months of supply. Now, that's still technically considered a seller-leaning market, right? 6 months is the traditional benchmark for a perfectly balanced market.
That's right. It's still leaning towards sellers, but the trajectory is clear. Supply is incrementally increasing while demand is shrinking regionally.
The key word there seems to be incrementally.
It is. If demand wasn't slowing so dramatically, that 11.1% drop in closed sales is huge, we would still be battling a severe inventory shortage.
Yeah.
It's the slowdown in sales that's allowing the inventory number to creep up, not some flood of new listings.
And this brings us to what I think is the most hopeful sign for a regional buyer, the Housing Affordability Index.
Yes.
The index saw a really positive jump of 11.5% year over year. It rose from 87 to 97. That signals a significant easing of financial pressure.
We absolutely need to pause and drill down on this metric. It's so important.
Okay, so what is it measuring exactly?
The Housing Affordability Index measures the relationship between three things:
Right.
median household income, the prevailing interest rates, and the regional median home price.
And a higher number is better for buyers.
Right. A higher index number means greater affordability. If the index hits 100, that means the median household income is theoretically exactly what's needed to qualify for the median-priced home.
So that move from 87 to 97 is a huge leap toward that benchmark of 100. What does an 11.5% rise actually mean for the median buyer's finances?
It means the system is correcting itself. The 5.4% price softening we just discussed, combined with, whatever mild increase in median income has happened, has substantially reduced the gap between what people earn and what it costs to buy a house.
So a year ago, the median buyer could only afford 87% of what they needed.
Correct. And now that number is 97%. We are right on the verge of reaching parity. It's a clear sign that market forces are working to self-correct some of the excesses that made North Texas just completely unattainable for a lot of people.
Okay, so to summarize the regional baseline, we've got pain, slowness, price adjustments, but also a growing sense of opportunity for buyers because of these affordability improvements.
That's the perfect summary. It establishes our context of a widely cooling Metroplex.
Now, here is where we need to introduce the paradox.
This is the fun part.
We've just established that the regional market is down 11.1% in closed sales. Prices are down 5.4%, and homes take 70 days to sell. If we look just 50 miles northwest of Dallas, into Wise County, how much better can it possibly be? I think people should prepare for a bit of a statistical shock here.
This is the data point that just defies logic in the current rate environment. Wise County is acting like a completely independent economic entity. It seems to be totally immune to the broader regional softness that's depressing sales everywhere else.
Let's start with the hard contrast on transaction volume. The entire North Texas region saw closed sales drop by 11.1%.
Right, a huge drop.
Wise County, however, saw its closed sales actually increase.
By 6%, an increase of 6% year over year.
That's a directional difference of 17 percentage points. That is staggering.
It's the ultimate confirmation of a localized, inelastic demand. In raw numbers, Wise County had 88 closed sales this November, up from 83 last November.
Okay, so it's a small jump in absolute numbers.
It is, but the fact that Wise County is accelerating, even just a little while the rest of the Metroplex is slamming on the brakes, is profound. It confirms a specific hungry demand that is localized to this one area, and that demand is just overriding the high-rate environment.
Why Wise County, though? Why this specific corner of the Metroplex? We keep talking about this escape the city factor, but let's get into the mechanics of why this demand is so resilient, or as you said, inelastic.
The demand is inelastic because it's driven less by, spreadsheets and monthly payment constraints and more by deeply held lifestyle goals.
Okay.
Wise County offers this unique combination. You get excellent school districts, you get real opportunities for acreage, privacy, and this is crucial continued, improving connectivity to the jobs and amenities in Fort Worth, Denton, and even West Dallas.
So it's not just about having space, it's about having strategic space.
Precisely. We've seen these demographic shifts, and they're driven by the permanence of hybrid and remote work. It's not a temporary thing anymore. For a lot of high-earning households, their job now lets them commute maybe once or twice a week.
So if you only have to drive in occasionally.
If you only commute occasionally, moving 50 miles out to get 5 or 10 acres, better schools, and a lower tax burden becomes a highly rational financial and lifestyle trade-off.
So for these buyers, the extra point or two on their mortgage rate is less important than achieving that quality of life.
Exactly. The demand for the Wise County product is strong enough to overcome the financial friction created by the current rates.
Now, the regional story says sellers are glued to their houses because of the golden handcuffs. If demand in Wise County is this strong, are listings just drying up there because nobody wants to lose their low rate?
And this is another massive deviation from the regional trend. New listings in Wise County actually increased by 8.8% in November.
Really?
Yeah, 148 new homes hit the market. This directly contradicts the golden handcuff narrative as the main constraint in this specific area.
That's a huge piece of data. So why are sellers in Wise County willing to move when their counterparts in Dallas or Collin County are not?
It's likely a mix of things, but they all point to greater financial flexibility. Wise County has a higher percentage of long-term owners.
So more people who've paid off their house or have a ton of equity?
A ton of equity. People who either own their property outright or have built up substantial equity over decades. When they sell, they're not necessarily trading a 3% mortgage for an 8% one.
They might be cashing out.
Exactly. They might be downsizing, retiring, moving out of state. They're cashing out that hard-earned premium equity. For them, the ability to realize a huge return on their investment outweighs the cost of moving.
And when you look at the year-to-date context, the sheer volume of activity there supports this idea of a healthy, functioning market.
Absolutely. We're not talking about a trickle of new listings. Over 2,200 new homes have hit the market so far this year in Wise County. That kind of volume suggests robust churn and seller confidence. The implication is that sellers there have confidence in the buyer base. They believe that even with high rates, their property will attract a strong offer and sell in a reasonable time.
Which justifies the move.
And that is the definition of a healthy, functioning market, completely detached from the regional story of painful contraction.
Okay, we've established rising sales volume and rising new listings. Now we get to the most nuanced and maybe the most confusing part of the data, the price paradox.
This is where we need to be crystal clear.
Because if you only read one of these numbers, you will miss the entire Wise County story.
This is the section that turns raw data into real intelligence. We have to look at both the median sales price and the average sales price. Looking at just one gives you a dangerously incomplete picture.
Okay, let's start with the apparent negative headline. Regionally, the median price dipped 5.4%. In Wise County, the median sales price dipped even harder.
It did. It fell 9.7% year over year to $325,000.
So if you just read that headline, Wise County prices down nearly 10%, you'd think the market is collapsing there.
And that would be completely the wrong conclusion. Remember, the median price is just the midpoint. Half of all sales are above it and half are below it. A decline in the median just tells us where the center of the activity is clustering.
Okay, now for the opposite headline, the one that creates the paradox. The average price surge.
Right.
The average sales price in Wise County rose by 7.1%.
A huge increase. It climbed to over $391,000. That 7.1% increase is massive in this climate.
So you have these two major metrics moving in completely opposite dramatic directions. The middle point drops almost 10%, while the average of all sales increases over 7%.
This is not market collapse. This is market segmentation.
Okay, let's unpack the statistical meaning of that. How can the average shoot up while the middle point is dropping? What is the data telling us about the flow of transactions?
It's a clear case of dual market activity. So imagine that in November, Wise County sold, say, 10 modest entry-level homes clustered around $250,000 to $300,000.
Okay.
Selling those 10 homes, maybe pretty quickly, pulls the median price down significantly. That gives us that 9.7% dip. It shows there's strong activity and accessibility in the entry-level part of the market.
But those 10 lower price sales are happening at the same time as one or two very high-end sales, like a multi-million-dollar custom home or a big ranch with a lot of acreage.
Exactly. That one single multi-million-dollar sale, or even just a flurry of strong sales in the, $600,000 to $1 million range,
Yeah.
dramatically skews the average price upward.
Because the average is sensitive to those outliers.
It's very sensitive to them. They're what's driving the average up 7.1%. And it demonstrates that buyers with capital see Wise County as a premium long-term investment that warrants a higher valuation, even while the entry-level market is becoming more accessible.
So the implication for someone listening is profound. The Wise County market isn't contracting, it's diversifying its product mix.
That's a great way to put it.
The luxury sector is setting new, higher price benchmarks, while the entry-level market has enough sales volume to pull the statistical middle downward.
And this phenomenon, it really speaks volumes about the economic health of the area. It suggests Wise County is successfully attracting two very different kinds of buyers.
Those looking for a lower price to get in than the core Metroplex.
And those who are willing to deploy significant capital for luxury, for space, for privacy, and they see those things as being insulated from what the Fed is doing with interest rates.
If those luxury sales are driving that average price surge, we have to ask, are those luxury buyers just immune to high rates, or are they using creative financing?
A large portion of those high-end luxury transactions are either all cash,
Okay.
or they involve highly specialized portfolio loans. So yeah, they are far less sensitive to the prevailing 30-year fixed mortgage rate. And on top of that, the high-end buyer often sees the asset differently.
They're not just buying shelter.
They're buying land and lifestyle. If a competing market, like a suburb in the core Metroplex, has these tight small lots, the unique offering of acreage in Wise County allows sellers to maintain or even increase their valuation, regardless of interest rates. The demand for large lots is just that strong.
We've established rising sales volume and this price paradox that indicates strength at both the high and low ends. Now let's try to define the current climate there in terms of market speed and balance.
Right.
If demand is so strong, how tight is the inventory and how fast are homes actually selling?
Well, overall, the market is really defined by stability and balance, not the kind of frenzy we saw a few years ago.
Okay.
When we look at the overall inventory, Wise County is sitting at 6.3 months of supply.
6 months is that theoretical point of perfect equilibrium where it doesn't favor the seller or the buyer.
It is.
So 6.3 months, that's a very healthy, balanced market.
It's a very healthy, balanced market. And that's a massive finding for anyone considering moving there. It means the market is absorbing all those new listings we saw, but it's not doing it instantly.
Buyers have choices, and sellers have to be strategic.
Exactly. This is no longer a frenzy where you just list your property and it sells itself. It's a stable environment where both sides can negotiate reasonably.
Speaking of negotiation, let's talk about the speed of sales. The regional DOM jumped up to 70 days. Given Wise County's unique demand, are homes there selling faster?
They are not. Wise County is actually slower still. It's averaging 98 days on market.
98 days. That's just over 3 months from listing to contract.
It is. And that pace reinforces the conclusion that the Wise County market has fully transitioned into what we're calling a professionals market.
A professionals market. What does that 98-day average 3 months of waiting? What does that fundamentally mean for a seller? How does that affect how they present their home?
It changes the entire emotional and financial calculus. 98 days is a long time.
It is.
If a property sits for that long, it's not because demand doesn't exist. We know sales volume is up 6%. It means sellers have to be meticulous about pricing, about staging, and about marketing.
So you can't overprice, even by a little bit.
If you overprice by even a small margin, when buyers know they have 3 months to look around, you will get zero offers. That 98-day window gives buyers plenty of time to vet your price against the competition, compare all the amenities, and negotiate hard.
I have to imagine that changes the emotional calculus for a seller. How do you advise clients to approach a 3-month listing period without panic setting in, especially if they're trying to coordinate another move?
And that's where the professional element comes in. The advice shifts from list high and wait for a frenzy to price it right on day one and market the lifestyle.
Right.
Sellers have to emphasize what makes Wise County unique: the acreage, the privacy, the schools, to justify that premium valuation that's driving the average price up.
So if the property doesn't sell in the first month or so,
If it doesn't sell within the first 30, 45 days, the market is telling you your pricing or your presentation is off. The 98-day average is not an expectation. It is a statistical reality that rewards patience, and penalizes unpreparedness.
So the 6.3 months of supply and the 98 days on market, it really suggests an environment of stability, which is a rare thing in this rate environment.
It's a stability that favors the thoughtful participant. It weeds out the speculators and rewards the serious, long-term buyers and sellers. It's a market that respects the process.
But even within that balanced 6.3-month environment and that 98-day average, we know that averages can mask extremes.
They absolutely can.
We have to talk about the extreme local hotspot, New Fairview.
New Fairview is the ultimate counterpoint to the average. It is ranked as one of the absolute hottest markets in the entire N-Trias region. It shows that demand can be intensely concentrated in specific micromarkets within Wise County.
How do we quantify that level of hotness? The report highlights a hotness ratio of 61.5%. Let's explain what that number is actually telling us.
The hotness ratio is a measure of absorption. It indicates the percentage of total active inventory that is currently under contract or pending sale.
And 61.5% is?
61.5% is intensely hot. It signifies extreme buyer eagerness. It means that for every 10 active listings in New Fairview, more than 6 of them are already spoken for. They're under contract, just waiting to close.
That is a staggering statistic, especially when the broader regional market is seeing pending sales drop by over 4%. What's fueling this specific concentrated demand in New Fairview? Is it new construction?
It's often driven by the intersection of new, high-quality development and a prime location. New Fairview is perfectly positioned geographically. It's close enough to major highways connecting to the Metroplex, but it's far enough out to still feel rural.
Developers see that sweet spot.
They do, and when new, modern inventory is introduced there, the demand just snaps it up instantly, and that's what leads to that astronomical hotness ratio.
And that demand translates directly into vanishing inventory. It confirms that even in a county that's generally balanced, if you're looking in New Fairview, you are still in a sprint.
Absolutely. New Fairview has only about 2.5 months of inventory.
Wow.
If sales continue at the current pace and no new homes are listed, the market would be sold out in about 10 weeks. The contrast with the county average of 6.3 months is just dramatic.
So buyers and sellers have to understand which micromarket they're actually in?
They have to, because the strategy for selling a ranch near Chico, where the DOM might be higher, is completely different from selling a new construction home in New Fairview, where you still need to be ready for multiple offers.
We have spent a good amount of time decoding the regional slowdown and this Wise County surge. Now let's synthesize all this data into some actionable insights for people, starting with the central lesson here, the value of local data.
The danger of reading those broad, sweeping headlines cannot be overstated. I mean, if you simply read that the Dallas area median price is down 5% or that closed sales are down 11% regionally,
you would logically conclude that Wise County is just an extension of that same decline.
But the data decisively proves that local markets operate on their own distinct rhythms. Wise County is fundamentally insulated by a specific premium demand for its assets and its lifestyle.
We saw higher sales growth than the Metroplex, and critically, rising average sales prices driven by that high-end demand.
Which confirms that the buyer base with capital is prioritizing lifestyle over short-term savings on their interest rate.
We've also confirmed the market is functional, but the pace has moderated. This slower, more balanced environment dictates specific strategies for both buyers and sellers, which defines it as that professionals market you identified.
Exactly.
So let's break down the strategies specifically based on that median average price split and the 98-day DOM. For sellers, especially those with high-end or luxury properties, the ones driving that average price up, what is the key tactical takeaway?
If you own a high-end property, the market is currently willing to pay an increased premium for it. That 7.1% jump in the average sales price confirms the premium is there.
However,
that average of 98 days on market is a huge strategic warning flag. You cannot just list a luxury property at some aspirational price and wait.
pricing has to be surgical.
It has to be surgical, and the marketing package has to emphasize the unique lifestyle benefits of Wise County, the privacy, the land, the lack of congestion, to justify that increased valuation. Sellers have to prove the value during those 3 months, or the buyer will look elsewhere.
Okay, if the luxury end requires surgical pricing, what about the entry-level seller? Those homes are contributing to that dipping median price.
Right. Entry-level sellers benefit from the 6% increase in transaction volume. Their properties are moving. But because they are clustered around that lower median price point, they also have to be aggressive on price relative to the condition of the home.
So the dip in the median suggests that sellers competing in the sub $350,000 range are having to accept offers that are lower relative to the high end.
But they are succeeding in closing the deal.
And for buyers, particularly those looking in that entry-level segment, the dipping median price is an encouraging sign that the market is offering more opportunity than before.
The 9.7% dip in the median price suggests there are absolutely more entry-level opportunities available at a lower relative price point than there were a year ago.
But they should be aware of those hotspots.
But buyers should be acutely aware of the hyper-hot spots, like New Fairview, where they still need to be pre-approved, ready to act fast, and ready to compete fiercely for that tiny 2.5 months of supply.
In the rest of the county, though, that 98-day DOM is their leverage.
It is. Buyers need to be pre-approved and ready to negotiate hard, using that 3-month window to their advantage to ask for concessions or rate buydowns. The pressure is no longer on the buyer to sprint, it's on the seller to justify the waiting period.
And for our listeners who want to verify these trends and explore the numbers further, we sourced all this data directly from Entrust.
That's right. The raw and trace summaries are publicly accessible, and many local real estate firms publish detailed market reports based on these figures.
So the key takeaway is to bypass the general news.
Bypass the generalized news reports and seek out those local experts who are dissecting these specific county-level stats. Make sure you get the Wise County perspective, not the regional noise. That localized analysis is the difference between making an informed, strategic decision and making a very costly assumption.
This deep dive into the North Texas data has been incredibly revealing. It showcased not just a market correction, but a dramatic geographic segmentation within a single metro area.
It really has.
Let's do a quick final synthesis, the 3 biggest takeaways that people need to internalize.
Okay. First, the volume contradiction. Wise County volume is up 6%, while the entire region is down over 11%.
Which confirms that localized demand for that rural lifestyle outweighs the macroeconomic friction from high rates.
Right. People are willing to pay the cost to escape the city.
Second, the price paradox. The median sales price dipping almost 10%, while the average sales price surged over 7%.
That points to profound strength and premium demand in the luxury sector, while at the same time offering increasing affordability at the entry level. The market is diversifying, not collapsing. And third, the market is defined by stability and time. It is balanced overall, sitting at a healthy 6.3 months of inventory, but it is certainly slower, with homes averaging 98 days on the market.
Which mandates precision and strategy for sellers, moving the market decisively into the hands of the prepared professional.
That's it.
So we've seen the Housing Affordability Index across the entire entry region spike dramatically, up 11.5% to 97. We know prices are softening regionally, and time on market is extending. This all suggests significant relief for the median buyer in the Metroplex is on the horizon.
It does.
As we head into the new year, the essential question for the coming months is this. Will that new regional affordability, that move toward the index hitting 100, coupled with increasing inventory, finally pull the masses of hesitant, rate-sensitive buyers off the sidelines? Will that increase transaction volume?
Or will the golden handcuff effect of owners refusing to sell continue to dominate the narrative and slow everything down, despite these vibrant, localized hotspots like Wise County and New Fairview?
That tension point between affordability and available supply.
That is the variable that will define 2026. The underlying demand is demonstrably there, but until the rate and supply equation fully breaks that golden handcuff hold regionally, volatility will persist in some parts of the Metroplex, even as premium markets like Wise County continue their quiet, robust growth.
That's a fascinating thought to leave with, and it gives us the perfect marker for our next deep dive. Thanks for guiding us through this incredibly complex data set.
Always a pleasure.
We'll catch you next time for the next deep dive into the sources you need to understand the world.